love the channel and find it useful in becoming a happy retiree. Subscribe today. Woo! What a week. As we head into the second week of February, today, Money Matters, wham. I don't know if that was a good enough wham. Dow falls 3,200 points, over 3,000 points in just a few trading sessions, just a few. Not just this week. We had all of this started the Friday before this past week, but we have so much to go over today. The emotion of why this hurts so badly, why this cascade is happening, what's likely for the market to do at this stage, and then I want to give you a recession update as we get into the reasoning behind a correction that's this violent and this painful. You've got to start looking at the fundamentals underneath. Are we going to go into a recession? Because that really matters to determine what this market is going to do next. And that's exactly what folks are wanting to figure out. That's exactly what you want to find out. And that's exactly what we're going to talk about today. So what a week in the market. Worst week we have seen, and by far the most mileage, if you will, if you counted up all the points that we saw this week. If you look at mileage, it's just a tremendous amount of movement from a point perspective and a percentage perspective, and that's really what matters. The one of the very worst weeks, really, we haven't seen a week like this since 2009, before the market, really before the cascade lower and the Great Recession started to end. And that, when you start talking about 2008 and 2009, that's a headline that grabs your attention. As long if you have a pulse, if you're human, if you've got ice running through your veins, maybe you don't care. But if you're paying attention and you're a living, breathing human being, this week has made the hair on your neck stand up. I was writing for the AJC last week in this article. The Atlanta Journal-Constitution will be out on Tuesday about this volatility. I was writing this article for the AJC going into the end of the week, discussing these historical 600-point moves in the market, like the one we saw not last week, but the week before Friday, and several of the moves we had throughout the week this week, 1,000-point plus moves. And I had to keep revising my statistics for that article all the way up to the very end of the week because we saw so many of these mega drops. So if you've been listening today, and if let's say you've been listening to WSB over the past week, or in times of corrective phases in the last, let's call it, decade or so, like the night after the election, when Donald Trump was elected, 2016, like the market corrections that we saw in really not just 2015 and early 2016, but all the corrections that we have seen since 2009, you've heard the same general advice. Hey, it's going to be okay. Corrections happen. Don't worry. Everything's going to be fine. And this recent route lower that we've just experienced, as painful as it is, I still believe that advice to be right on the money. However, I think it's important to acknowledge that these drops they're painful. These drops, if you're an investor, they hurt. Most people really, they cringe at the sight of seeing their money seemingly washed away. You look at your account and you've built up $500,000. You built up $500,000. It's taken you a lifetime to do it. Took you 40 years to do it, and it doesn't matter how much you have. Maybe it's 200,000, maybe it's 500,000, maybe it's 2 million, maybe it's 5 million. But either way, it's taken you your entire life to build it up to where it is today. And then you see it drop 20 grand or 30 grand, or depending on the size of your portfolio, 50 grand, 500 grand in a week. And that hurts. It just, the bigger the portfolio, the bigger the dollar amount gets on a percentage basis. And quite frankly, it can hurt. And that contributes to this high level of emotion that is tied back to our money. I mean, to some extent, and I've written a lot about money and happiness, and money does not buy happiness. Or at least it does, up until a point. I do believe money does buy happiness. And if you've read You Can Retire Sooner Than You Think, I have a study between, the relationship between money. How much does it take to get to a point where more money doesn't really mean any more happiness? But in the beginning stages, so when you're just getting your feet on the ground in America, you got to have a certain amount of money to just kind of survive and eat and have shelter in America. So in the purest sense, the basics of money in today's world, it really equals survival. And a baseline level of money equals survival. So and that's the world that we live in today. Perhaps psychologically, there's this linkage to, hey, it's what was survival 1,000 years ago? Well, it's just food and it's shelter. And today, you've got to have at least a little bit of money to have food and to have shelter. And that might explain why psychologically or neuropsychologically or neurophysiologically, we get 4 times the pain when we lose $1. 4 times the pain when losing $1 than the pleasure we get to gain $1. And I went back this week and reviewed, this is really neuropsychology. It's the insular cortex in the brain that involves emotion, and there's a ton of it when it's tied back to emotion. There have been so many studies about this, and you can measure the emotion or the emotional activity in that part of the brain associated with winning or losing money. And if there's anything that lights up, it's the insula area, and so it's the emotion behind money, and particularly losing money. So yes, so we're looking at this study after study. If you win at cards or in an experiment or in a game, there's some reaction in this area of the brain. When we lose money, even $10, it doesn't matter. We get 3 to 4 times the emotional response in that part of our brain versus when we gain money. And think about this as an investor. When the market's going up, we've hit so many of these all-time highs. That means your portfolio has probably hit all-time highs again and again and again. And you log into your Vanguard account or your Fidelity account or your Schwab account, and you look at it and you say, wow, that's about as much as it's ever been. And then you log back in a week later and you're like, wow, that's about as much as it's ever been. Hey, looks really good. But what's the emotion behind that? You're not jumping up and down. There's a little bit of satisfaction. You say, oh, well, it's good. It's good. But you log in, and right before your eyes, in the real-time world that we live in, and you look at your statement and boom, you lose $1,000. You lose $5,000, 10 grand, 100 grand. Imagine the fireworks that are going off now in your insular cortex. Imagine the chaos that's going on in your brain as you experience that loss. Fight or flight, emotional pain. I don't know exactly what it is, but it's all the above, and it's more in your face than it's ever been. We can look at our money on a second-by-second basis every second of every day that this market is open. So I get it. Weeks like the one we just went through, they're just not fun. They're not fun for investors. It's much more fun when the escalator is steadily climbing week after week after week. But as you know, markets move in both directions. They don't just move up. You know that. And now that we're headed in the other direction, it feels unsettling. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.